Welcome everyone, and thank you for joining a panel discussion today on ESG. My name is Valerie Gibbs, and I'm the Vice President of CFA Society Edmonton. And today's event is a collaboration between CFA Society Edmonton and CFA Society Winnipeg. So before we begin, I've got a few housekeeping items I'd like to note. First is that we have reserved time at the end of our panel discussion for Q&A. So we ask that you please use the Q&A feature that is found on the control bar at the bottom of your Zoom meeting screen to type in your questions. Second is that you will be receiving an email following the webinar with a link to a survey, and we would really appreciate if you could take a couple minutes to give us some feedback regarding this webinar so that we can improve our programming going forward. And lastly, this webinar will be recorded, and a link to the recording will be shared with all participants and registrants. And also, if you'd like to know about any other events the CFA Society Edmonton or perhaps Winnipeg has on the go, we ask that you please follow our LinkedIn page. Okay, it is now my pleasure to introduce you to our speakers for today. First is our moderator. Her name is Melanie Adams. Melanie is the Vice President and Head of Corporate Governance and Responsible Investment for RBC Global Asset Management. She's also a member of the Leadership Committee. So her group supports RBC Global Asset Management's investment teams in integrating environmental, social, and governance factors into the investment process. So she serves on the board of directors of the Responsible Investment Association as vice chair. And so here I would like to welcome you, Melanie. Thank you very much for taking the time to be on this call today. Our first panelist now is Emily Burt. Emily is the Executive Vice President and Chair of the Board at Cardinal Capital Management. Based in Winnipeg, Cardinal manages nearly $4 billion in asset and is a signatory of the UN Principle for Responsible Investment. Emily currently serves as the president of CFA Society Winnipeg and also sits on the board of CFA Societies Canada. Welcome, Emily. Our second panelist is Ian Robertson. So Ian is a portfolio manager, director, and vice president of Oldham Brown. And he's also a member of the firm's executive committee. He's a regular speaker and writer on responsible investment in North America and Europe. Ian is a past board chair of the Responsible Investment Association, the UBC Foundation, the UBC Alumni Association, and CFA Society Vancouver. Ian, welcome. And our third and not least panelist is Jason Milne. Jason is the founder of Koru ESG, an independent environmental, social, and governance consulting firm, providing advice and support to investors and issuers on material ESG issues. Jason has specialized in ESG, corporate governance, and responsible investment for over 20 years. Jason currently serves as British Columbia Securities Commissioner, and previously served as a board member of the Responsible Investment Association of Canada. Jason is a CFA charter holder, holds the CPA CGA designation, and is a SASB Fundamentals of Sustainability Accounting credential holder. Welcome, Jason. And Melanie, from here, I'll pass it over to you.
Thank you very much, Valerie, and thanks to everyone for joining us today. I'm really looking forward to the dialogue. I think we've got some great panelists today. So we're just going to get in now that we've had the introduction and get right into some of the questions. As everyone knows, the topic is ESG factors, and how industry is evolving and companies are evolving to think about these different criteria. So the first question, and before actually getting into the first question, I should say, please do feel free to ask your questions, put them in the Q&A, and we will probably get to most of the questions at the end. So first question, we're seeing ESG dominating the media. It's both in a positive way, but we're also seeing more recently, and in particular, in the US, but also in some other areas as well, we're seeing some ESG backlash. So I'd like to start by cutting away some of this noise. What is ESG? Is it good? Is it bad? And really demystify it. So Jason, if we can go to you first, given your experience with both investors and issuers, can you explain, to set the groundwork for us, what ESG is, different categories of ESG, and how this differs from corporate social responsibility?
Sure, thanks, Melanie. So there are a lot of sort of corporate social responsibility issues that companies deal with, and these are the kind of things that make them good corporate citizens. So supporting their local community, how they treat their employees, these kinds of things. And really what differentiates a corporate social responsibility issue from an ESG issue is financial materiality. And so when we talk about financial materiality in the context of ESG, we're using the same definition that the securities regulators use. So basically something that has the potential to impact the stock price of an issuer. So for example, if you think of a beverage company, if that company is located in Arizona, they have probably quite significant water risk, where if that company was based in British Columbia, probably those risks are very different when it comes to water. So that financial materiality threshold is really what turns a corporate social responsibility issue into an ESG issue, something that really has that potential to impact the stock price. And when we talk about sort of ESG in terms of ESG integration for investors, that's really looking at those material risks and incorporating it into your risk assessment or your risk profile of the companies and how you're assessing risk on a portfolio basis. So it's so really it's not the things that are not financially material but may make a company a good corporate citizen, but really financial materiality is that key when we're talking about ESG.
That's great. Thanks, Jason. I think that was a great description too of the corporate social responsibility. Ian, if we can turn to you now, can you talk about what we mean by specific ESG factors and maybe provide some examples for us to put the context and lay the groundwork there, and how these might play a role potentially in financial risk return, and talk about, Jason talked a little bit about materiality, and maybe you can talk about that as well from the perspective of your processes.
Great, thanks, Melanie. For this question, I think this is exactly the right audience to think about this question, because when we use the word factor, we all go back as charter holders to think of sort of 3-factor, 5-factor models. And I actually just want to start with that, the sort of value or growth or quality of company or size, those factors that go into CAPM. And in the search for more factors, ESG looms large, but most research shows that the ESG factors that we think about, there's a broad range, and I'm going to get to those in a sec, that they're commingled with other factors such as company size, for example. Size is directly related to how much reporting companies are able to do. And so when you put the ESG factors into those kind of more formal models and think about risk and an optimized portfolio, that it's a challenge. It's not as clear as those original factor type models. And that leads to challenges later on when you want to do performance attribution or risk determinations in that kind of more formal CAPM, CFA type of way. I want to just, before getting to some specific examples, highlight CFA Institute's guidelines for ESG product features, which I think are helpful. There are, I know the RIA has, I think we were 7, and GSIA, the Global Sustainable Investment Alliance, is 7, or vice versa, I can't recall. Anyway, there are slightly different nuances to classifications, but the CFA Institute one is ESG integration, number 1, ESG related exclusions, so screening out, number 2, best in class. So think of that as the top rated ESG companies in all the different industry sectors. ESG related thematic, and I'm going to give some examples of that. Impact objective, and number 6 is proxy voting, engagement, and stewardship. And so this is where it's going to circle back to the Fama and French example in the more formal definition of factors. So specific factors for screening for ESG related exclusions, that second one, might be things that's the old sin stocks. It's tobacco, gambling, coal. Now, well, coal isn't a sin stock, but now it is in our lower carbon environment. And for many people these days, it's oil as well. Specific factors, so that was the 4th one, ESG related thematic, that might be considered there are clean energy or water or demographic change, healthcare availability. So those are kind of thematic ones. So instead of screening out things that we think are bad or may underperform, emphasizing things that have a positive direction. So that brings us to issues like carbon intensity, which is a common theme for investors. It's a common theme for retail investors, my clients. And I think it's a fairly common theme in institutional investing as well. And so you could think of carbon issues, carbon intensity of the stocks in your portfolio as exclusions. You're going to exclude them. Divestiture would be one sort of example of an action that universities take, for example. Or you could think of it as thematic. And so that actually loops back to the Fama and French. And so it makes one wonder whether carbon intensity and carbon footprint and carbon risk are actually fundamental risk factors that might actually find their way into a more formalized 6-factor model, add another one, down the road. So that's kind of a blended response to your question about factors. But really, I think as CFA charter holders, we think about it from both perspectives, the sort of common nomenclature one, but also the more formal factor models.
That's great, Ian. Thanks very much. Now, Emily, turning to you. We've heard a lot about the connection to risk and return from Jason, Ian, and how some of these factors might be considered and how they might impact an issuer. But we're also seeing a lot of media recently that ESG funds are failing as investment choices. Can you explain this media, this little bit of ESG backlash, and how do you respond to this portrayal? And how does fiduciary duty factor in?
Yeah, those are great questions. I'll definitely start with the media portrayal of ESG investment options failing. And I would say that first, the issue is that most media, like newspaper articles that I've read, especially in the last couple of months, they attempt to lump all ESG products into one bucket. Where I think the focus has been lately has been specifically on the products that are this true negative screening. And negative screening represents the oldest, simplest approach to ESG investing. You know, this is like 25 years plus. That I think even I read something dating back to 1800s where, you know, it was often an ethical approach. The sin stocks were excluded, and it's most commonly requested by investors, not so much that it's an asset management approach by an asset manager. So if you consider this exclusionary or negative screening approach, it can be cost effective. It's generally a very passive strategy on ESG. It just it takes ratings of companies and it axes off, you know, the bottom half. So this can be an effective way for an investor that, you know, wants to feel good about where they put their money in. But the latest articles I've read make the claim that what's happening by investors putting their money in these traditional ESG exclusionary funds is that it means that nothing is being done to engage in companies to improve. So, and I think this is accurate. And I do think that as time goes on, negative screening will always be an approach, but it's not really a true ESG integration type of approach. And I think The socially responsible approaches are going to be gaining momentum. I think investors will start to realize more that if you really want to see change and make a difference, you actually want to be investing with managers that are more active, maybe to the extent that they're really engaging and seeking companies to make change. Taking what would be considered a brown company and turning it green. Those are the things that I think are quite interesting, and I think that as time goes on, we'll get there, but it does mean being much more active. And it's a little bit harder, I think, for investors to understand what active engagement can really be and what it can do. But it's just going to take some time there. On the fiduciary subject, I think this is an interesting one. And I think there's a bit of a misconception that, as a fiduciary, your goal is simply to make the most possible returns for your client. And that's sort of historically been a reason why some managers have claimed they do not want to incorporate ESG or socially responsible practices into their management. But I think where things have been moving actually is through the UNPRI. They've spent a lot of work on this. This is really, I think, stemming from Europe, where a lot has been done to change people's perspectives on the fiduciary duty. And there's three areas that I think really hit home for me when I read through this in the CFA's ESG certificate course. The first is that when you're considering your clients, you need to consider their investment time horizon. And ESG factors tend to be very long-term. So if you're a manager, say, maybe I'm not day trading cryptocurrencies. So if I'm a long-term manager buying stocks and if I'm a buy and hold manager, if I plan to have my clients for multiple generations, then I think a long-term time horizon is important, and ESG issues start to be also important to the investments that you hold. Another thing is that they're coming out and saying that encouraging high standards in ESG performance in the companies you're invested in should also be a requirement as a money manager. That's a fiduciary. The third thing, and I think this is sort of back to that traditional exclusionary approach, is that as a fiduciary, you do in fact have a responsibility to incorporate the beneficiary's sustainability related preferences into their investments. So, if an institutional client doesn't want to own SIN stocks, we have the fiduciary duty to do that for them, even if it does mean that it could impact their returns. So these are sort of I think the three main areas that ESG touches on the fiduciary topic.
That's great. Thank you so much, Emily. And I think it's great to see that we're getting some questions in the Q&A, which actually dovetails quite nicely with the next topic that we're going to cover, which is regulation. So thanks for setting the groundwork. Now, Jason, are you able to speak to some of the evolving regulations around ESG and the challenges that issuers are facing, given your role working with issuers and just seeing the question coming in the Q&A, if you've seen a difference for private versus public issuers that you'll be able to touch on as well there?
It's interesting, the distinction between public and private companies, and definitely public companies have been at the forefront of disclosure, but also receiving the sort of regulatory brunt of this as well. But increasingly, private companies are looking at ESG disclosure as a value add and something that they really need to do, especially for private companies that are looking at going public. And that's certainly You know, as I talk to my clients, that a number of them are private companies that are either looking at going public, or that their providers of capital or lenders are asking about ESG performance. So that is something that's increasingly on the radar screen of private companies as well. Just on the regulatory piece, I think we are starting to see the regulators become more active on ESG, especially requiring disclosure around ESG issues. So we have been we've had this in place on the G side for quite a while now. So if you look at a proxy circular, for example, there has been standardized disclosure around executive compensation, board independence, for example. So the G side, that requirement for disclosure has been there for a while. What we're seeing at the moment is some initiatives by the CSA in Canada and the SEC in the US to develop some rules around requiring disclosure around climate risk. So these proposals are out for comment at the moment. The Canadian and the US proposals were quite different in their approaches. So I think in Canada, they're looking at that SEC proposal and seeing if they can get a little closer to what the SEC is proposing. But this is coming. I mean, even though there is discussion around what it will ultimately look like, it is coming. And then there's other areas such as diversity and inclusion, where the regulators are starting to look at requiring disclosure around this issue as well. So definitely we're seeing the regulators starting to look at where it makes sense for them to get involved. But generally, like issuers, I think, especially larger issuers, are out ahead of the regulators. They are already disclosing on a variety of ESG issues. It's also encouraging to see the recent progress towards a global ESG reporting standard with the initiative from the ISSB, the International Sustainability Standards Board. So this is 4 organizations are coming together to develop a global standard for disclosure that is it'll be similar to the global accounting standards that are already in place. So SASB and the TCFD will really form the foundation for this new disclosure regime. So there are 2 existing well-developed disclosure standards. So it will bringing these organizations together and standardizing the disclosure will make it a lot cheaper and easier for issuers, both public and private, to provide this kind of disclosure. And for investors, it will make it much easier to compare company to company, apples to apples, in terms of their ESG performance. So this is, I think, a really encouraging development, and it should sort of remove one of the barriers that we're seeing to, really understanding ESG risk and the companies we're investing in.
That's great. Thanks very much, Jason. So over to you, Ian. Can you talk a little bit about how advisors are speaking about ESG with clients, how responsible investment ties in with client requirements?
Yeah, great. Thanks, Melanie. It is a topic of discussion, and I think you'll find a range of discussions and a range of capabilities or steps along the learning curve amongst advisors. Maybe I can just talk about the regulatory part from my perspective and bring it back to a couple of specific examples. So last year, at the end of last year, some regulatory reform was brought in, and there were 4 key areas. I think this is from the CSA's website, which in my case flows through to IROC, right, the regulator for people on my side of the business. And so these KYCs, the reforms, these know your client reforms, specifically for ESG, mandated a discussion about clients' interest in ESG issues. So that would, for us to have those discussions as advisors with clients, it would go back to the first question you asked of the 3 of us. And so some knowledge by advisors on how these things play out and what the factors are and how you can implement them and what's financial material and what's more values alignment in the maybe screening approach. There also is a requirement to know your product, and that includes for ESG products, and that brings in an evolving area of labeling for funds, how you know what you're getting, but it also brings in, if you're doing things yourself, the processes that you have, and we can talk more about that later. The third thing was the information provided to clients about the firm you're working for and the scope of products and services so that they can tell if it's suitable or you're just getting in-house products. And the fourth one was titles and product description. So they wanted to make sure that in these reforms that titles such as a sales-based VP title, that you didn't just get that vice president title for being, the top salesperson. It had other responsibilities, and same for product descriptions, including for in-house products. So let's circle back to the KYC and the KYP as it relates to ESG. That's a lot of alphabet soup there. But I want to bring it back to the process and how we as advisors talk to our clients, because they come to us with different views and different values. And so the discussion can take a lot of different directions. And it's a matter of an ongoing discussion with them about what is financially material, what processes and products might help them outperform when we take ESG issues into consideration. So sort of ESG integration and active ownership, and what's more a values alignment. And so their values of I just don't want tobacco companies in my portfolio, or coal, or whatever it is. And we're seeing examples in various areas of regulators coming in around the world, and just making sure that what is being promised or discussed actually has some basis in a standardized procedure, a verifiable procedure. So we have the Aussie, just today in the news, the Australian super funds being investigated for greenwashing. Were they not delivering what they said they were doing for their pension fund clients? We have a whistleblower at DWS, part of Deutsche Bank, last year, maybe it was earlier this year, saying that what DWS is advertising is not actually what's happening in the background. We have the Republican states that Emily talked about earlier politicizing ESG, and the screening and divestment issues that the Republican states are interested in. And I just have finished a conference here in the US where they had a panel that RIAs, which are sort of smaller discretionary portfolio management groups regulated by the SEC, that the SEC was coming in and auditing them, and they have their standards, but they're also learning a bit as they go and asking for verification and proof of what they're saying to their clients they're delivering and the processes that they use to do that. And so I think we're going to see more of that at the individual advisor level. So we're having these discussions. The regulators are coming in and saying these are the things you need to discuss, and soon we'll start seeing verification, I think, from various regulators.
Yeah, lots of regulation at all levels and globally. I think that's been a huge theme that we've seen over the past couple of years, and we'll see into 2023. So let's turn now to talk a little bit about ESG data, an area that has seen tremendous amount of growth over the past few years. And Emily, if we can start with you, what does ESG integration look like at your firm, and what is the role of ESG data?
Great, thanks, Melanie. Our firm has integrated ESG into our fundamental research of the companies that we invest in. So it's, we're a true bottom up, we do in-house research here. So incorporating ESG risks is just sort of a natural thing for us to be doing. We certainly do look at risk ratings from third parties, but we also integrate ESG into our own analysis of the companies that we're either already invested in or companies that we're looking at. So when it comes to social and governance, it's tough to quantify those things when you're valuing a stock. You can quantify the environmental factors a little bit better, but it's still subjective. The data there, I would say, there's certainly a push for trying to standardize how companies report, or even having their data audited. I think all of that is positive, but from our standpoint, what we think is the most important is looking at how that data moves over time. It's not a single point in time, but it's more directional. Our long-term averages going up or down. So that's more what we look at. We also look at the company's annual sustainability reports. When we're speaking to management, we definitely ask ESG related questions, specifically on themes that are material for those companies. we track our engagement with those companies. So, I mean, data for us, while standardization is not really currently a thing, there's so much, it's tough for some of this data to even be totally relied on when so much of it is estimates. They're trying to estimate greenhouse gases or trying to estimate carbon emissions. Those numbers aren't real because no one is, holding a balloon over a factory and actually measuring the exact amount of emissions, especially if you look at, a financial company or, you're trying to gauge emissions and it's all based on global averages and they put a number down on paper. So I think looking at the long-term trends is really the most important thing, and that's what we try to focus on.
Yeah, that's really great. That's helpful. And I agree with you. The trends is really important, and it'll be really important to get enough data dating back enough years so that we can look at those trends, which has sometimes been an issue as well. Jason, from your perspective, do you have anything to add to that from the issuer lens on the question of data?
Well, I mean, I think as we've sort of heard a little bit here, like ESG and sustainability, it can be a very sort of noisy place, and so issuers have a lot of people shouting very loudly at them about what they should do or shouldn't do, the kinds of things they should be disclosing on. So it can be challenging for them to really sort of say, okay, what are the important things, and what information should we be providing? Because it's not cheap for companies to provide good disclosure around these issues. So again, coming back to financial materiality, that helps a lot. Like if a company can sit down and say, okay, this issue is financially material, so we really should be disclosing to our investors and stakeholders on this issue. So taking that financial materiality lens to a lot of this noise allows companies to focus in on what's important. And again, the SASB and ISSB initiative, I think that standardizing of that disclosure really does help guide companies to provide that decision useful disclosure for the investors, which I think is key, that sort of gold standard where that information is really useful for investors and is comparable company to company.
Yeah, that's great. And I'm glad you touched upon the cost, Jason. It makes me think of a study that I recently read that said, if an issuer on average is spending about $500,000 on ESG data, asset managers are spending about 1.3 million a year on data. And that actually resonated with me because it's certainly been, the experience on that just to meet regulatory and client requirements. So really big area right now. So Ian, if we can turn to you then, you're seeing this from the, when you're talking to clients, are clients asking, or when we talk about it with clients, how are advisors using the data to have these conversations with clients? What do the cost implications look like there? And do clients give this data any weight? And Emily touched upon some of the issues that we've seen with the data.
Yeah, Emily's lead off on this question was perfect, because Emily, what you were describing was a sort of true bottom-up ESG integration approach, and you're probably getting some of the same data that we use. Advisors, in many cases, if not most cases, are getting their research delivered to them from their in-house research teams, whether that's a medium-sized firm like Odlum Brown, a large bank-owned firm, or even a small shop. And so as recipients of that, we don't have the ability to do what Emily does, which is integrate it from the ground up. We take what's delivered to us. But that's not to say that we don't use data to help inform our portfolio decisions, or that we don't talk about these things with our clients. So in our case, we use a third-party provider of ESG ratings, and we use Sustainalytics, but MSCI would be the other big one, and there are lots of other ones as well. Those are big comprehensive databases with 50, 70-page reports on each company. The cost for that is probably somewhere in the neighborhood of $15,000 to $20,000 a year. I mean, it depends how many companies you're subscribing to. And then if you want extra things like carbon footprint or carbon risk and some other areas, then that's going to be added on. So great if you can get your company to pay for it as advisors. It's a cost that you would think twice about. And so and you might use that as an overlay to help tilt the portfolios. And in some cases, you can share that data, the reports, with clients. So for example, somebody might have a poor image of a company, let's say Starbucks, and just think that they're, not good, but then Starbucks, I don't know if this is true or not, but Starbucks comes out well in the ratings, and so they're in the portfolio, and the client may say, well, I see that's in there, I have a bad impression of them and the cups that litter the ground or whatever it is. And so you can share that sort of more comprehensive information with them. It's not something we do on a regular basis, but it's there as a point of discussion and for clients to dive in if they want. The second thing that we get outside information from is proxy voting. And it's important for us to vote our proxies. And so sometimes that's taken care of internally within the firms, which is very helpful if you can have that kind of system done. But in many cases, advisors are left to their own devices, which again, historically meant that they didn't do it. And so you have these sort of four steps of proxy voting, I think. These are my own classifications, so nothing official, but is you have advisors or institutions that don't vote. You have advisors or institutions that take a binary approach, which is always support shareholder proposals or always vote against. In other words, always support management. So all ones, all yeses or all nos. Then you might have some guidance, which is what we get. ISS and Glass Lewis are the two biggest ones. There's GIR in Quebec, which is terrific. That's the one we use, which has an affiliation with SHARE, our national kind of engagement, not-for-profit. And then the fourth step would be that in addition to just following that, and Melody, I'm guessing this is what RBC does, is that you take all of this input, but you have these extraordinary in-house teams that take all of the information and then make your own decisions on a lot of the, you take it as an input, but then add value. That's probably beyond what most advisors could do. But so really there's the two parts, the security selection, and then there's the active ownership and the actual proxy voting. And the proxy voting costs are more modest than the ratings. They're probably in the neighborhood of $3,000 to $5,000 a year for guidance and proxy voting support.
Those costs sound actually quite great, Ian.
Yeah, I have way fewer stocks in the portfolios than RBC, but that's for sure. You have all the stocks.
Okay, thanks very much for that, Ian. So let's, we talk about risks. We talk about the ESG risks when we're looking at a company, and earlier we heard from Jason on water risk. I'd like to talk about opportunities for a moment, and maybe we can go back to Jason first on this. How are corporations thinking about ESG opportunities and implementing on them to capitalize? Are they taking into account all stakeholders? Do they, when they're thinking about opportunities, are they only thinking about shareholders and shareholder return?
So often when companies are sort of looking at the opportunity side, I'd say sort of most of those opportunities are falling probably within sort of two broad buckets. And one is on the cost side, and the other is in terms of brand. So just on the cost side, so many of sort of ESG initiatives, they have a positive impact on cost. So if we take, for example, a REIT, when that REIT sort of retrofits one of their buildings and adopts like sort of high energy efficiency lighting, better, more efficient HVAC systems, reducing waste that's going to landfill. It's great, it's positive in terms of their ESG, managing their ESG risks, but it's also positive in terms of reducing costs, operating costs for those buildings. So that's often what you find, is that these sort of ESG initiatives have a cost impact, which is usually positive. So it helps reduce costs, and which helps grow margins, which is good for the share price. So that's one bucket. The other bucket is in brand, and so there's sort of, this is positive and negative. But on the positive side, growing your green credentials or showing that you're a responsible company has a very positive impact on brand, especially for companies that are, in terms of like selling products to final consumers. So things like, if you have a lower carbon footprint for your product versus your competitor, and you highlight that in how you're positioning your product, that can help grow your sales, grow your brand in terms of brand recognition, and And so that again can have a very positive impact in terms of the bottom line, growing your revenue, which grows your share price. So I think they're sort of the two big buckets. In terms of an investor versus a stakeholder view, and this sort of opens the door to the question on stakeholder capitalism. I think if companies are taking a long-term view, and ESG issues tend to play out over a longer term. So if you're putting in high efficiency light bulbs, it's not going to impact your quarterly earnings that much, but over the long term, that cumulative impact is quite significant. So if a company is taking a longer term view, generally that aligns with all stakeholders, not just investors, even though your primary consideration may be your investors. So, it's hard to sort of speak for all issuers, but I would say, a lot of what they're doing here is focused on investors, but by default, because they're taking a longer term view, it does benefit all stakeholders.
Yeah, that's great. I think that's a great perspective, Jason. If we could turn to you, Emily, how does your firm think about opportunities as part of your ESG integration process?
Yeah, so opportunities I think can come in a few different flavors. The one that I think is most important to us, because we tend to buy industry leaders already, we're sort of a large cap manager. So what type of opportunities we look for are what these industry leaders are doing to invest in like the future state of the world, really is sort of how I would characterize it. So an example would be utility companies that are investing in wind and solar. I mean, those are the sorts of things that you want to be talking to management about and understanding what they're doing to sort of move from an industry leader today to still be an industry leader of the future, or are they going to become obsolete in the next 50 years? So I think it's important to understand what opportunities are out there and know if a company is or is not thinking about those things. I think it's generally, I sort of see opportunities as innovation. That's a big component of it. And also, another example would be Alimentation Couche-Tard. They're sort of the biggest EV charging station currently in Europe, testing it there, planning to bring it to the States. Otherwise, a similar company in a similar industry that isn't moving towards the future state of, battery powered vehicles, where are they going to be in the future? Are they investing today in the research and development and fundamental business changes that I think they need to still be relevant in the future? So those are the sorts of opportunities we look for. There's so many others in sort of the ESG realm that I think are not so investable to us specifically. Whereas, venture capital or private equity would be examples where, they would want investments to flow into new businesses, heavy into R&D, developing new technologies, things like carbon capture. There's going to be so much money flowing into innovation, especially revolving around, I think, environmental subjects. And some of that is maybe not so investable from our company's perspective, but certainly there's so many opportunities out there to be had. Another way to, I think, invest, there's specifically opportunity funds that are ESG type funds. And those could be either investing in this sort of new technology of the future, or some of these opportunity funds focus on actually sort of transporting sort of brown companies into green companies, improving the poorly rated ones, whether it's on E, S, or G factors. And that can be, I think, a really interesting way to put money to work in an engagement and stewardship type of a fashion. And it could potentially lead to a really strong return. So I think those are opportunities that are also interesting.
That's great. And Ian, over to you. Are clients thinking about opportunities? Or are they more focused on risks?
Well, thanks, Melanie. They're focused on both, but I should clarify that they're focused in a different way than those of us on the panel and on the call might think about it, because we're all trained to sort of have these, to measure alpha, to have a risk-adjusted return over and above a benchmark. And what clients focus on is that sort of values resonation with what they don't want in the portfolio or what they think will do well. So to answer your question about opportunities and risks, they just naturally associate an oil company, a coal company, you name your company, that you might want to screen out as a bad risk, and so it should be out of the portfolio, and a wind company or some other type of company with positive attributes as an opportunity. And retail clients have always done this. They kind of have an idea and they think, oh yeah, this would be a terrific thing, or I don't want to be in that. And what's different with retail clients, from what Emily very well described, is that they're not really looking at the price. They're not looking at they're really just thinking this is a good idea and I should run with it or I should avoid it. And that's sort of where the larger discussion comes in about risk and return and the overall effect on a portfolio.
That's great. Thanks, Ian. I'd just like to take a minute. I see there's a couple questions that have come in. A lot of, both of them, the new questions focused on ESG ratings, which I think is really interesting. First, I'd like to just talk about the CFA ESG certificate for a moment. It's been over a year since the CFA Institute increased the availability and reach of the certification in ESG investing certificate that was developed by the CFA Society in the United Kingdom. There's a lot of people who have taken this course, including both Ian and Emily. So maybe if we start with you, Emily, can you speak to your experience taking the course, and then we'll hear from Ian on it as well?
Sure, I'm happy to. So I decided to take the certificate mainly because it sort of dawned on me that from the time frame I finished my level 3 CFA to now, ESG content was not what it is today in the curriculum. So I did want to add that knowledge base, and the certificate, I think, did just that. I was really pleased with how broadly it covered the different types of ESG that's out there across different asset classes. It provided, I think, a really good knowledge base, whether it's history, ways it can be integrated, and just sort of how we've gotten to where we are today, and a bit about where we're heading. So yeah, I would highly recommend it. It probably took me 3 weeks to kind of chug through the material, but it's not daunting. And you could do the exam from the comfort of your home and find out that you passed immediately after submitting it, and then immediately pour a glass of wine. So I liked that too.
That's great. Perfect. How about you, Ian?
Yeah, I'd echo Emily's comments. I think it was really well prepared. I've seen a number and taken a number of responsible investment ESG courses over time. So I might just read out the 9 chapters just to give folks an idea of the content. It's about 550 pages, let's say. So the 9 chapters are Intro to ESG, the ESG market, ESG, that's 3 chapters, engagement and stewardship, ESG analysis, valuation, and integration. That's the sort of bringing it right back to the core of the CFA program. ESG integrated portfolio construction and management, which was not something I had thought about in as much depth as I thought I had. So that was a great chapter. And then finally, investment mandates, portfolio analytics, and client reporting. So it really covers a broad range, as Emily said, extremely well written. The other credential that I think is well worth, especially those on the analyst side, taking would be the FSA credential that Jason has, which is a sustainability, the SASB credential, which is, if I recall, is it 2 tests of 40 hours of study each, Jason? I think that's what it was.
Yes, that's correct. 2 tests, and it's about 40 hours each. Yeah. It's a.
And Jason, can you recommend, or tell us if you'd recommend that course as well while we're on the topic?
Yeah, it was very good, and speaking as an accountant, it definitely complemented, I think, you need my sort of accounting skills when it comes to ESG disclosure. So I think anyone that's going to be working with an issuer on ESG disclosure, I think this is a great credential to help sort of take it from broader ESG disclosure to things that will actually that decision useful information and how to present it, how to think about it. And what I found very useful is sort of that connecting it through to those financial impacts. So even though these are sort of non-financial factors, ultimately there's a financial impact. So sort of thinking about those channels of impact, which I found quite useful for me. So I think it's a good credential, but it definitely is focused more on the disclosure piece rather than the investor or the portfolio construction piece.
Okay.
Can I add, Melanie? I meant to say earlier that for the ESG certificate, you don't need a calculator. Just to give people an idea that it's not the CFA charter holders are scared of calculators, but it really is at the conceptual, the historical, the framework level.
Yeah, and that's interesting, right? Because that's a little bit of a different way of for CFA charter holders to think about things. If we could get into some of the questions, there's a few questions now, and the first question, and this is a really good one, an interesting one that something just came up for me today, and I always go back to this Tesla example that we saw in the paper. What do you think, and I'm going to open this up to anybody who wants to respond, and maybe more than one person wants to weigh in on this, but what do the panel members think about a firm like Tesla that seems to rank highly on E but poorly on S and G? And how do we deal with that when we don't have regulated ESG ratings or some type of regulated system for this? How should we think about it? Does anyone want to put up their hand right away? It's a hard question.
I would just say that these are opportunities for active managers to outperform if they can dig into the real fundamental underbelly of a company. I don't see it as a negative necessarily. It's just something for active managers to take advantage of.
And maybe also an opportunity for education as well, that there isn't just one definition right now out there about what a good ESG company is, because ESG means a lot of different things. And so you could be good in one area and poor in another, and there's an opportunity, as Emily says, for improvement there. I don't know, Jason or Ian, if you wanted to add anything there.
I'd probably just add that, this is sort of I think a bit of a misconception that, it's that you can have two competing views on the ESG performance of a company. And I always compare it to taking a sort of a value versus growth approach for an analyst. And you can have someone who takes a growth bias versus a value bias and come up with two completely different views of the same company, and that's okay. And so this is just the same case where you may weight different factors within your analysis differently, and you come up with your view of the company, and you may be right, you may be wrong, but that's ultimately the market will decide, make that decision on how right you are. So I see this as something that again, sort of analysts can add value to their clients in terms of the portfolio by undertaking this analysis.
I might just add that I think that's, as you mentioned, Jason, that's one reason why ESG funds can be so uncorrelated, because it depends, are they a social impact fund? If so, maybe they're not investing in Tesla, or are they an environmental fund? So yeah, as you mentioned, Jason, is it value or is it growth? Claiming that a fund is ESG, you have to look at exactly what their goals are, like what's the scope of the impact they're trying to make, because what they're really investing in can be very, very different across the board.
Yeah, I think those are great answers. And the next question we have is also related to ESG ratings, and it's a two-parter. What are some of the metrics that are looked at to evaluate a company's ESG rating? And secondly, how would you weigh the short-term versus the long-term improvements of a company, as many of them have not started at the same point? And so I don't know if anybody wants to kick us off on this question. I'm going to sign it.
It's a tough one because it asks for the details about the metrics used to it. But as a subscriber to, in our case, Sustainalytics, and having seen MSCI's, I can tell you that the large rating agencies use a lot of metrics. They use materials from the company, but they use a lot of outside material. There are even some that don't take anything from the company. They assemble all of the data from outside, which is more work, but then it's probably a bit more objective. And the short-term versus long-term, I think, is a key issue, and especially for perpetual asset owners, universal owners like pension funds who really have a long-term. And this was exactly Mark Carney's point to Lloyd's and the insurance industry in London, whatever it was, 6 or 7 years ago, before the establishment of the TCFD. For reporting, to say you keep looking on the short and medium term, but eventually these long-term risks like climate change are going to come and impact your bottom line and your profitability and your risk exposure. So start looking at them now and look at the long term. And I think pension funds do a very good job at that. And my guess is that the rating agencies actually are more aligned with traditional finance and the shorter term, 18-month to 2-year time horizons. But I couldn't say that for sure. But I think it's endemic in our industry that things tend to be short term, and a lot of these issues, as you point out, are longer term ones that need to be addressed. And that's where the analytical input comes and the value we add for clients.
Yeah, I think that's great. I think that's a great answer to Ian. And I think maybe Jason, on the issuer side, I don't know if you would say that companies, they might be starting at different points, but from an investor perspective, what you're looking at is, where are they and what is their intention? What is their plan and their strategy to get there, even if they are starting at a different point?
Yeah, and I think and size matters on this as well. So for smaller companies, especially companies that are just starting up, they're faced with a lot of short-term issues. So those ESG issues that are often just not material at that early stage in their evolution. So when you're a startup and you're trying to get to break even or raise enough capital to get your product to market, like they're sort of short-term issues. So whether they face climate risk, over a 20-year time horizon is not really material at that point. But as they mature and grow, those ESG issues often become more material as the company evolves through, becomes larger and are looking at a longer time horizon. So size does matter, and that long-term versus short-term, I think, does matter as well. And just on the metrics, I think Emily touched on this earlier. I think, personally, looking at changes in overall score, especially significant plus, improvements or deterioration in scores is more meaningful than the actual score. So when you're looking at those ESG research providers, like looking at those change points can often be quite informative, because you're seeing companies where something's happening there, and that's worth taking a look to understand what's driving that change in their ESG score.
Yeah, I think. Oh, Ian, yes.
I just wanted to, it's probably worth mentioning at this point, the two largest providers of ratings, for example, use different methodologies. They're actually academic studies that compare them and say that they don't really line up that well. But Sustainalytics, if you have 100 companies, 10 sectors, 10 in each sector. So Sustainalytics ranks all the companies 1 to 100. It's just the risk of the company and how they deal with the risk. And Sustainalytics uses a best in class. So they rate each of the 10 sectors 1 to 10 in the within there. So you're going to naturally come out with different results, and it's important to know that kind of thing for all of the information providers you work with.
That sounds great. And just, I see Valerie's coming back, and I know I'm going to pass it off to her. But before I do, there's one more question that I don't want to go unanswered. So we're going to do rapid fire. The question is, how many, so given there's so many resources, do you have any good ones you can recommend for candidates to stay up to date on the day-to-day ESG news? And maybe you can each just name 1 or 2, and we'll go rapid fire. We'll go Jason, then Ian, then Emily.
Bloomberg Green, I think, is one I subscribe to that I often find is quite useful just for keeping up on the day-to-day stuff that's coming out.
ResponsibleInvestor.com. You can search for Responsible Investor Magazine and it'll pop up.
That's a great one too. And Emily.
Muted. There's a good podcast that Matt Orsa runs. I just can't think of the name of it right now. And he brings in guest speakers all the time. If anyone knows which one I'm talking about or can find it, I tried to look for it quickly, but I'm not fast enough.
That's okay. Well, I'll do a quick Google afterwards. I don't know the name off the top. So thank you, everyone. And back over to you then, Valerie.
Thank you so much, Melanie. Wow, that was so insightful. So to you, Melanie, Ian, Jason, and Emily, thank you so much for taking the time to be with us today. For all of you that are still with us, so as part of the email that we're with the link to the survey, we're also going to send you a link to the ESG certificate, so you can go and have a look and see if that's something that that's of interest to you. Again, thank you to all of you on behalf of CFA Society Edmonton and Winnipeg. Enjoy the rest of your day, and we will see you again soon. Bye.
Bye, everyone. Thank you.